And so I think that in the next few years in the United States, you will have persistent inflation and persistent labor shortages. And therefore, automation, robotics, AI, anything that you can introduce to help alleviate those shortages, corporations are definitely going to utilize. In the United States, what you're going to see is the blossoming of the real economy, of the mom and pop economy. That is going to do a lot better than the Wall Street economy that did very well during the 2010s. And therefore, I do think this is the golden age for mom and pop. I do think this is the golden age to be a domestic business, serving the domestic market in the United States.
And good afternoon, everyone. Thank you for spending your valuable time right here with the ADAPT 2030 channel. As always, I try to bring you the best minds out there that are showing us the way and have insights into how we can protect ourselves and our families moving through these changes of this particular reset in this 80-year iteration or 400-year, whatever you believe the cycle is, a once in a 2,000-year cycle, 480, but definitely overlapping. And we see the changes around us. It's unmistakable now that these changes are here. So I have Lior Gantz with me right here from the Wealth Research Group. We're going to talk things hyperinflation, BRICS, deglobalization, which not a lot of people talk about. How are these regional supply chains going to function versus what we had with globalization? We got the unemployment and this huge push for companies to move over to lean management and utilizing AI, cutting their workforces. We don't need you anymore. AI can do 10 times more than you anyway. So where does that leave you with your home payment and your possibility of having your home repossessed or not having a job to pay for more expensive things as we move through this whole transition? So Lior, I do appreciate you joining. The floor is yours.
Thank you. Thank you for having me. What would you like to start with?
Well, the deglobalization is a good one because what we're seeing in the States here is less availability of goods in the stores. And if they are there, they're more expensive. And some things that people used to rely on in terms of items are just not available anymore. You inquire from the purchasing manager or whatnot, sourcing agents, and there's nope, it's not coming. We don't know. We can get a substitute product for that. But, daisy chain this out. When we start going from globalization down to deglobalization and regional supply chains, where does that take us for daily needs that we might need that we've all relied on so far up then to this point in our lives?
Yeah. So globalization and deglobalization, they go through long cycles. The last deglobalization cycle went from around the early 1900s, so about 1908 until 1945. That was the last deglobalization cycle. During that time, you had the formation of the Federal Reserve, you had World War I, you had the Great Depression, and World War II. So deglobalization is very destabilizing. And then you had globalization. Globalization is not perfect. It has its victims and victors, but it normally entails a big empire that is so much bigger than anything else on the horizon that there's actually peace by way of a bully policing the rest of the countries, and that's basically what we've lived through for the most part. Whoever wanted to challenge the hegemony saw a war, but there weren't a lot of regional big wars and a lot of countries looking to become empires, because there was a very stated empire in the period between 1945 and today. And it actually went into hyperdrive after the Soviet Union fell in the early 1990s. So what you saw is hyperglobalization. Countries that have nothing to do and no vested interest in globalization actually joining globalization, and it actually distorted many things. And you saw a lot of Americans during this period in Iraq and Afghanistan asking, why are we here? What are we doing? Like, what's the big picture here? We don't understand why we're here. And that is very much a trait of the late stages of globalization.
It's not often that I'm left jaw-dropped by reading an exclusive report from a publication I think is spot on with their coverage of economy, politics, and investing. And had such a good interview with the founder, Lior Gantz, wealthresearchgroup.com. He's a sought after guest on many podcasts because of the publishing of his portfolio publicly at wealthresearchgroup.com/portfolio. Up over 28% in 2023 so far, but seeing the future so clearly. The trends, the analysis, and how our financial world as well as daily life might move through the rest of 2023 and 2024. I think you should download it now and check it out for yourself. It's about central bank digital currencies, de-dollarization, deglobalization, and how they're trying to outlaw cash and take away our liberties and privacy. Go to wealthresearchgroup.com/CBDC and wealthresearchgroup.com/CBDC2. It's a two-part series. That link's in the description box below, and that's why we're having this interview right now.
Then you saw Obama's speech in 2011 starting to end the era of globalization, and Trump's speech in 2018 in the UN was really a warning that, hey, globalization is ending, and we are looking to become way more national. The thing that really stuck out is the COVID era, because during COVID-19, you had a global problem. You'd assume the first day of the breakout, you'd have a G7 meeting, a G20 meeting, a UN meeting, a big globalist meeting to solve this. In a globalized world, you want a global solution. And what you saw is the other way. You saw finger pointing. You saw countries like Sweden keeping it open and Australia closing it down for 2 years. You saw zero COVID policies in one country, another country looking to basically live with it. And all of this created what we now have, which is a deglobalization cycle that just began. So we are in a deglobalization period, 100%. We had deglobalization happening between 1908 to 1945, globalization for another 80 years. And by the way, before that, before 1908, you had a globalization period which saw the invention of the car, the airplane, electricity. So globalization brings a lot of innovation with it as well. And so you can see innovation in both. War brings a lot of innovation, and peace brings a lot of growth and innovation, two different types of things. So it's not that the world is going to go backwards, but there's a lot of redundancy. That is basically the main point of deglobalizing. You're creating the supply chains that are already there are going to have to move, are going to have to be de-risked, are going to be more diversified. You can't just trust one country to supply another country. Just like you saw in Europe, Russia supplied Europe with natural gas and oil since the late 60s. That is done. It's over with. And so these types of restructures are going to happen everywhere. And when you have a fully furnished home, as an analogy, and your wife says, hey, I don't like everything we have, let's throw it away and buy new, that's very inflationary because you already paid for furniture. Now you have to buy new. And that's what's happening, but on a global basis. So companies are moving away from China and are basically having to create their entire supply chains in other countries. And that is that type of redundancy is making things more expensive, making things less reliable, less on time, and like you said, it's creating shortages and whatnot, and it's also creating closed trading agreements, where in the world of globalization, people, ideas, money, everything moves around freely for the most part. In deglobalization, you create pacts or treaties or regional type relationships and not global relationships. A country like the US can say to Mexico, hey, you trade with us. If you trade with China, we will do this. So all sorts of threats and ultimatums come into the picture. Countries trying to nationalize supply chains or nationalize commodities. You saw Chile doing that a few days ago with lithium, for example. All of these things are going to happen and happen more and more. And I think at the base of all of it, you need to look at how the dollar is getting looked at or re-looked at. The sovereign risk, the sovereign credit risk in the United States, indexed by Wall Street's biggest banks, is at an all-time high. In other words, around the world, there is now a growing concern that the way that the United States is structured in terms of its national debt, its deficit, the debt ceiling debates that are coming up, its obligation compared to its growth trajectory, and everything else that has to do with the way that the dollar was served to the rest of the countries in the world for the last at least 50 years under this fiat monetary system with the petrodollar, the Saudis, is coming to an end. You already saw normalization between Saudis and the Iranians, arch enemies, which allowed China to be the peacemaker. And that's a big deal because that's a sign, and that's a blatant sign that the Saudis are moving away from the United States and looking for a new sugar daddy. And that's important. That's really important, actually.
Can I jump in for a second here?
Absolutely.
It was a good analogy with the furniture going out. So, with most of the OPEC nations, they're on the Belt and Road Initiative, which China has set up. It's sets of rails and shipping lanes and air transit routes, et cetera. So how does that really morph? Okay, countries are going to pledge their natural resources into this new quote unquote BRICS currency or BRICS aligned nation, whatever monetary system that will be. But if a majority of the world's oil supplies in OPEC are aligned on that side of things, then, what kind of risk does that leave for the United States of, like it was in the 1970s with a full oil embargo, but this time, it's not going to be weeks or months. It's going to be until we find a new source or we start production back here in the U.S. and Canada once again.
Yeah. So in terms of oil production, the United States right now is actually in a very good position domestically, and not just in oil, but natural gas. So the risk or the bet that Presidents Obama and now and then Trump and now Biden are making is that the United States oil production domestically and its natural gas production could be very independent. And actually, we are exporting LNG to Europe, and it's in America's interest to prolong the war between Russia and the Ukraine, because LNG and the business of war, which was the business of the United States during World War II as well, selling to Europe and staying out of the war and selling weapons and anything else that they needed until the threat of Germany became too great to ignore, and threatened the United States, and obviously what happened with Japan almost coming to the shores of Seattle and San Francisco, etc. I think what we need to look at is one, how risky is an alternative BRICS currency, and how imminent is it? So for now, the BRICS are an association. They're not even a real organization. They're very early, even though they're making a lot of news. There is nothing that is concrete about the BRICS. It's not an economic alliance or anything like that. It's more of think of it more like a think group at this point. In terms of the reliability of their currencies, if you look on the global basis, most countries would not side with a currency backed by the Chinese or the Russians or the Brazilians or the Indians and the South Africans. They would mostly default as it stands, even with all its problems, to the dollar or the euro. The dollar makes up about 60% of global reserves, and the euro is about 20%, and actually the yen is number 3. I think that what we will transition into is, one, you need China to become the world's biggest economy GDP-wise, and that's likely to happen between 2027 and 2029. Once that happens, then they can dictate a lot more. In 2035, the UN estimates that they will have the biggest military in the world in terms of its budget. They will obviously not have a bigger navy than the United States by then, but they will have a bigger military budget. And that's important because that's basically, if you look at history, whoever had reserve currency status was the biggest military. So that's when you get into the real risk of China making a move. And I think what the move will be is not to dethrone the US dollar as a reserve currency, but to create a second reserve currency. And then you have two blocks, which is very Cold War era environment. You have the Eastern Bloc with China and Russia and the countries that will go with them. And you have the Western Bloc with the United States and the countries that will go with them. And probably you'll have some sort of a settlement or intermediary exchange between them so they can trade with each other. We have to look at a few things when we project into the future, how China will look like in 10 to 20 years, how the United States will look like, and how the world will look like. One thing that you have to keep in mind with China is that because of the 336 million abortions that they've had during the one-child policy era, their culture is to have one child. Even with all the government incentives that try to encourage women to have more than one child, they give them excessive perks and tax breaks and help with first homes, etc. The Chinese family wants to have about one child right now. And there's also a disproportionate amount of men versus women. So you have eternal bachelors in that country to the tune of, I think, of over 100 million. In terms of their demographics, it is in free fall. 2022 is the first year that their population has actually shrunk. And I think that if you look at demographics is probably the easiest thing to forecast because you already know how many 20-year-olds you have. Therefore, you know 10 to 15 years ahead how many productive workers you'll have in 2035 to 2040. And for China, their pyramid, their age pyramid looks really bad. The age that was before the one-child policy, the age of the boom is huge, and they're aging past the 65 and into the future. They will have a lot of people that are non-productive, and then they have a small group, a very small group that is productive. Their population could shrink materially into the future, and they obviously know this. Everyone that studies demographics knows this, and that's a really important factor in how they think about things. You can look at how Russia thinks about things because it's in the same plight. Their demographics is also collapsing, and that's why everything that they need to do really quick. They need to invade the Ukraine real quick to get access to the Black Sea. They needed to do if they're going to expand, if they're going to do anything that's really important, they will do it very soon because now their military is as big as it's going to get. Same with China. If they're going to make a move on Taiwan, it's going to be very soon. If they're going to make a move regionally in the South China Sea, it's going to happen very soon. If they're going to make a bigger move, let's say on Australia, it's going to be very soon because as the years go by, their military might, in terms of its budget, is going to grow, but in terms of the amount of people that they will have available, it's shrinking, and we have to keep that in mind. The United States, on the other hand, is in a different spot demographically. It's still growing, and it's growing in a way that is below the GDP growth. In other words, GDP is gonna keep eclipsing population growth, and every generation is going to keep being richer than the one before on average. And I think that what we need to really think about is what is the priority of the United States. The priority of the United States is to stop being the global military power and to start to come in and become more nationalized. And because of that, there's a vacuum around the world. Wherever the US is pulling out of or staying out of, there will need to be new powers. So Germany has just issued the biggest ever military expansion that they've done. Japan, the same thing. If you look at Japan's 5-year military plan, it's huge. They're going to become the third largest military in the world. They're preparing for a day when they and the Chinese will clash, and the Americans will come in and aid them with weapons, maybe, but not with soldiers. Same with Germany. And so in this world where the United States is actively telling its partners and allies, hey, expand your military. We will help you by giving you our best weapons that our manufacturers can do. But other than doing business with you, we're done paying for your military. We're done doing what you need to do for yourselves. And that's the biggest change that you're talking about. That's the essence of deglobalization. And in that world, you don't need a global reserve currency, the dollar, to facilitate a petro dollar system, because that's not the world we're going to live in.
Must be something giant on the horizon that everybody's seeing, except that information being let out to the public. Because I study on the ag side, and the information was pretty clear for those who studied that we didn't grow enough wheat 3 years ago to facilitate what everybody's demand was, but there was those carryover stocks, so we could dig into that, and it's digging into your reserve. But this is the third year in a row now that we didn't grow enough wheat worldwide, that we're going to again dig into the carryover stocks. And it looks like this year's wheat harvest and forecast, at least through what they're showing out in the USDA and the drought zones in the US, is going to be far lower than it was these last 2 to 3 years. Everybody needs to eat. And for me, looking at the Ukraine being one of the largest bread baskets across Europe, the way I would look at it is Russia's in there also, like you say, for the Black Sea transit routes, but also to take that as a food growing area, a bread basket on the planet. And China, I don't know, I used to work in China and lived in Myanmar, or exported coffee out of there. And, would they go in with military force? Because only 50% of Myanmar's arable land is under production now. So again, you could double that. And back in the 1960s, Myanmar was the largest rice exporter, which actually eclipsed China because most of what was grown was used internally, and they didn't have the export market in the early 1960s. So you look at these different plays of where and what are all of these countries trying to set up in terms of very bountiful crop growing regions that everybody has their eyes set on. So if you look at it in terms of geopolitics of where the best food growing zones are, and perhaps there's something coming that's larger with another one of these disruptions that would limit food supply, then my question really is, with these food shortages that are impending and at least extreme inflation in food coming, would this speed up or slow down some of these plans you're talking about for China expansion and Russian expansion? Everybody needs to eat, and they always have that old saying, a belly or the army moves by the belly, whether they're fed or unfed.
Yeah.
Civil War as well. Yeah, they didn't eat. These guys stopped down here.
Yeah. I think that you bring out a very important point, which is food supply. And to me, I think that we are in a very vulnerable place in terms of the global food supply. There are already countries that are suffering from it. It's obviously not in the news because it's not in the Western world, but it can reach a point where some foods are even in a shortage in countries that and with people that have never seen a shortage in food. They don't even know it can happen. They're used to going down to the supermarket and getting whatever they need. So I do think that there are threats. Obviously, Russia and Ukraine being huge producers of agriculture product is intense. And yes, those reserves really helped weather the first year of this war. But if a truce is not brokered, if there's nothing on the horizon that helps speed up production, it will be a problem. I think that in the Middle East, it can become a real issue with some countries that rely on exports or imports from Ukraine. Latin America is vulnerable to that as well. If you look at the biggest importers of Ukraine produce, those countries are in a plight. And the problem is that there are poor countries, and therefore the amount that of disposable income that already goes to rent and food is already high. So if inflation attacks food first, that's going to really impact the poor first, and that's the double-edged sword that we have here. So I think that you're right, and in a deglobalized world, a lot of countries would weaponize food produce. They would leverage it. In the world that we had before the Bretton Woods system, all countries were looking as much as possible to be as self-sufficient as possible. Every country had to look at how it gets its energy, its food, its basic materials like copper and iron ore, etc. And in the globalized world, countries had it easy. They were part of this big system that really helped them leverage anything and everything that they had. If they just had people, they could multinational corporations would come into the country, would bring a lot of wealth, and then they can import anything that they need. They didn't need to produce for themselves, and now it's ending. It's unwinding, and I think that you're right to point out the risks of famines, not only in these poorer countries, but in a country like China, where you have to feed a lot of people, and you just don't have the free market enterprise system that efficiently creates enough of anything for the market.
Yeah, because the way you speak, it sounds like there's going to be a huge disruption then in terms of what we consider globalization, shipping, logistics, freight forwarding, these types of things. Unemployment's going to be a huge one. And everybody now, I grew up in the Lee Iacocca days where it was lean manufacturing, the old way that the American manufacturing for motor vehicles was done was clunky, ancient, and just way underproductive. And then you bring these lean Japanese manufacturer methods in, and whoosh, it changed the world in a second, this lean manufacturing. I think we're going back to a 2.0, because I've heard you talk about unemployment a couple of times. But now AI just magically this year is really rolling out, just even for the average person on ChatGPT and anything from text to image. And there's just hundreds and hundreds of different applications for using AI for the general public now. And I couldn't even blink an eye without believing that corporations are setting themselves up to, dispense with a good percentage of their workforce, which would be redundant anyway in this deglobalization phase, and then just set everything up into those who had mastered the usage of AI, and then have those persons produce 10 times more with the help of some of these new augmented systems.
Yeah. What's happening let's start with the United States, for example. In the United States, because of the mass retirement of the baby boomers and the fact that the millennials that are inheriting their jobs are not enough to fill the amount of occupancy and job openings that the baby boomers are leaving. You have an inherent labor shortage in the United States of about 2 to 2.5 million people, and that's going to last between now and 2029, because of the demographic gap between the boomers, which are a huge generation, about 80 million people, and the generations that come up to them that are smaller. And so because COVID and other circumstances drove a lot of baby boomers into retirement and not coming back at all, this structural labor shortage in a time when you need a lot of work in the services sector, which is the biggest sector of the U.S. economy. You have wage inflation, you have salary inflation, and that's basically what the Fed is grappling with. Raising interest rates is not going to change that. And to create a recession in order to end inflation. That's not what Powell is all about. And so I think that in the next few years in the United States, you will have persistent inflation and persistent labor shortages. And therefore, automation, robotics, AI, anything that you can introduce to help alleviate those shortages, corporations are definitely going to utilize. In a higher interest rate environment that we are in, and I don't think that we're going to change that anytime soon. You will see the government stepping in and doing a lot of fiscal stimulus and fiscal policy, what they didn't do during the 2010s, because interest rates were zero and the tech industry basically blossomed and was able to hire a lot of people in. Now you will need to have the government stepping in, because, as you said, companies are going to need to be very lean in order to create a profit at the bottom line. Growth is not the mandate of the 2020s. Margins, profits, the bottom line. That's what investors care about. That's what shareholders care about. That's what management teams care about. Board of directors. That's what the world cares about. How do you create a profitable enterprise, not an enterprise that's growing, and just hiring in order to get more market share from competitors? That era is done. It's over. The zero interest rate era. So in this world with higher interest rates, persistent inflation, and persistent labor shortage in the United States, what you're going to see is the blossoming of the real economy, of the mom and pop economy. That is going to do a lot better than the Wall Street economy that did very well during the 2010s. You're going to see less people invest in the stock market, more people investing in either bonds or just staying in cash because they're in retirement and they need to de-risk their portfolio. And I think that moving to alternatives such as gold and silver is going to be more popular during this decade. And that's what I see for the United States. Okay. So in other words, I think that between now and 2029, we are in a structural dollar bear market, and hard assets, commodities, anything that's real, that's tangible, is in a bull market. Anything that's intangible, like tech and innovation, where VC money would fund companies at ridiculous valuations, that's over with. So that's what I think about the United States, and therefore I do think this is the golden age for mom and pop. I do think this is the golden age to be a domestic business serving the domestic market in the United States. And by the way, if you're talking about housing, I know a lot of people are talking about another 2008, etc. It is true that there are problems with the housing sector, with housing affordability and higher interest rates. The bigger thing to keep in mind is that in the United States, there's still a shortage of about 2 million homes. And because of higher interest rates, a lot of builders are reluctant to build. So it's sort of a loop where you have a shortage of homes, you have high interest rates, and so you also have a shortage of new building. And therefore, I think that if you're predicting another 2008, I would caution that it may be too dark of a script.
It's the way I was looking at it with the real estate. Yeah, if people become unemployed, they're not going to really have a second chance to get rehired by a country. So that mom and pop emergence makes sense, because people are going to have to start serving people in their local communities again. And those that are unemployed, correct, you have two choices. You either go out and hustle and create something for your local community, or you're not living in your house anymore. And that's a very scary prospect for almost anybody. And you mentioned gold and silver in the 1930s, the way the government was able to foreclose along with the banks on an enormous amount of homes. they couldn't pay. Okay, well, that's just a subset. But even those that had completely paid off or were in the process of still being able to make their payments, if they couldn't pay their property taxes. So, at least in this go around, to have some metal set aside to be able to cash in and continually pay your property taxes. So if you're living in a paid for home, that you don't lose that this time around. It's quite a few variables. And I don't know, Lior, the 1930s is very different because it was such a slow era. You got to think about communications at that time compared to this lightning fast draining out, banks in 2 days, that sort of thing on bank runs electronically.
Yeah.
So, the speed at which these things are going to onset, but also the speed at which the solutions will be made and then V in and out of this contagion, collapse, and then reemergence again. I think maybe it's a naive point, but it might come a little faster because our interconnectivity and communication is so much faster that solutions might evolve at lightning speed right along with that.
That's actually a brilliant point, and a nice observation on your part, because if you think about it, the way that the Federal Reserve studies the Great Depression, if you look at any paper published by the Federal Reserve on what their mistakes were during the 1921 to 1929 to 1932 period, it's the slowness of their response. And Bernanke was a great scholar of the Great Depression, immediately went into action, and unprecedented action. You saw that again with Powell and COVID-19, immediately slashing interest rates to zero, creating all sorts of facilities, going as far as saying we'll buy all the junk bonds in America if we need to. And actually, what was amazing about that is they never bought a single junk bond, but just the promise that they will ended the plunge, the 35% plunge for the S&P in 21 days or whatever between February 21st and March 13th, which was the bottom in 2020. So I think that you will have a very quick response. The good and the bad. The good is interest rates are in about a few days from now, the Fed funds rate is going to be raised to 5%. That's amazing when you think about it, right? It was zero just 2 years ago. It's the fastest ever rate hike cycle that they've done in 110 years of existence, the Fed. So that means that if they need to start cutting into a recession, into a slow, into a hard landing, into a depression, they have a lot of slashing to do. Going from 5 to 4 to 3 to 2, that's a lot. And then it also helps to keep in mind that the big banks, JP Morgan, Bank of America, Wells, they are in a fantastic financial position. They are not as leveraged. They're not leveraged at all compared to 2008. They don't do any of that exotic or risky behavior. For the most part, structurally, they're very sound businesses. And so the banking sector is in a better place. Housing, like I said, in the 2000s, you had a housing glut. Basically, builders were building everywhere. You obviously know how easy it was to get a loan and then sell that loan to somebody else who's unwise to the risk of it. Today, it's so much different. I am a big real estate investor, both in residential, meaning single family, in large units, 400, 500, 600 doors, so big multi-family complexes, and in what we call trophy assets, so iconic buildings throughout the United States. And this is through funds that I'm invested in. And I can tell you that right now, what all fund managers are looking at is where the breaking point is. The housing sector is basically frozen. The buyers are saying to themselves, sellers are going to capitulate soon. And the sellers are saying to themselves, if I can just hold on for another month or 2 or 3, I won't have to sell for lower. I can just eke it out. And then, maybe the Fed will ease or something will come my way. So that standoff that we see is going to end at some point. Either interest rates are going to break the leveraged participants in the market once they need to refinance at higher interest rates, or the Fed is going to ease and we're going to move out of this stealth mate between buyers and sellers. But the market is definitely frozen. And that's really important to keep in mind, because the housing sector is the largest employer in the United States. It employs directly and indirectly more people than any other industry. And about 70% of all US millionaires throughout its existence have come from housing, including the former president. So I think that we need to keep in mind how important, how vital housing is to the United States economy, and demographically, it looks very healthy. In other words, once we're done with this interest rate reset, we are in an environment where millennials are moving out of the house. After 2 years of not dating each other during the COVID years, they're getting married in droves, and they need to form new families. With the hybrid workforce, they're moving into new areas. So demographically speaking, America is buying homes. It needs to keep buying homes throughout this decade. So between everything that's going on, I think that what's really important is how the Fed will continue to manage interest rates, and will the government be able to create stimulus in an environment where they are blamed for creating too much money and all this inflation. So that's the mess that we find ourselves in, and that's why I think that it's very prudent to look at alternatives. If you want to look at my portfolio, for example, go to wealthresearchgroup.com/portfolio, and you can literally download my entire portfolio, my stock market portfolio, that is. But if you read our newsletter and follow our free newsletter, you see that I'm very much invested also in real estate, in debt. Debt today can yield, especially to our retiree, between 10 and 12%. You can earn 10 to 12% in a fund that is invested in debt. There are many alternatives out there to look at. And then I want to really stress that I think that commodities, gold, silver, and other commodities are going to do very well in protecting your wealth during this period. If you look at the 21st century, gold is the best performing large asset class in the world, going from 250 an ounce to 2,000 an ounce, an eightfold move in 23 years. We have not seen any major asset class creating the same returns. And man, if Warren Buffett at the year 2000 would have taken just a third of the cash pile that Berkshire had and put it into gold, instead of complaining that gold does nothing, because he keeps comparing it to companies instead of comparing it to cash, Berkshire would probably be $1.5 trillion to $2 trillion in market cap, and not where it is right now. So he's actually done a lot of disservice to his shareholders by overlooking the brilliance of the monetary unit called gold. So I think that's one key thing to keep in mind, especially as we are inches away from a new all-time high nominally for gold. With silver, I think it's very interesting for two reasons. One, it's the only major commodity out of the 32 that is trading for half of its nominal all-time high. There's no other commodity that has seen such an incredible discount to its all-time high in 2023. And so that's really interesting to me. I think that what's even more interesting is how misunderstood the dynamics of silver is. Silver is the most inversely correlated commodity to the price or to the value of the dollar. So if we are entering a structural dollar bear market, silver is going to do way, way better than gold. And I think that actually silver, from where it is right now, the 25 an ounce range, it can definitely reach the 50s and the 60s and perhaps even more. To industry, which is 50% of the consumption for silver, it won't matter at all. People think that this is like oil, where oil goes from 100 to 200 a barrel, the world collapses. But silver is put in microdoses in thousands of different products. And if the price of silver is 25 or 35 or 45 or 55 or 65 to the industrial products that it's in, it might not even change the end price to the consumer. It's in such small amounts and quantities that it doesn't register. Just to give you an idea, wheat, for example, is only about 10% the price of bread. The labor and the supply chain is 90%. So if wheat is only 10% of the price of bread, you can think of how much silver is dictating the price of an iPhone or a laptop or solar panels, etc. So I think that this decade is going to be a lot more about diversification, whereas the 2010s were just, hey, just go long tech, and you'll do better than fund managers, right? Going long the Nasdaq was 14% year-over-year returns for a full decade. That's astonishing when you compare that to hedge fund performance. But this decade is going to be the flip side of that. The large indices are probably going to be underperformers, and you will either need to be very strategic in your stock portfolio, or you will need to look outside of the stock market for how you protect your wealth and increase your wealth.
I'm going to go long history, because even if you look at that gold to silver ratio, even if it comes back 15 to 20 to 1 on parity, you're still looking at a 3x rise. What is it, 80 today, set in mid 70s to 1, even just historically, and then the demand for that too, for people protecting their wealth. I mean, the things Lior and I talked about today, might look, gloomy or somewhat on the surface, but really behind that, this is the biggest opportunity in human history, period, hands down, never has been. Biggest population on the planet, most wealth on the planet ever, and that is going to move and change hands over this transition. And some people call it a reset. It's just history repeating as goods and services are going to move into different places. And you can pick your chapter of history. It's just like that. But Lior, I hate to put you on the spot. Last question for you.
Go ahead.
What's the average person? What's a person listening to my channel, ADAPT 2030? What are they going to do about all this? We laid out a bunch of big picture stuff. Now, what can they do? Get a couple ounces. So, I mean, really, what can the average person do, with the opportunity in front of them and with all of these other circumstances setting up for it to be the biggest opportunity in history?
Yeah. I think that if you're 65 and over, if you're in retirement, I think that you need to consider the fact that statistically, you will probably live for another 20 to 25 years. And therefore, to plan that savings will facilitate your lifestyle for an additional 2 decades, I think that it shouldn't be your primary plan. This idea of retirement worked very well 100 years ago and perhaps even 50 years ago, when retirement was at 65 and the life expectancy was 70. If you look back in history at where the idea of retirement started in socialistic Europe, it was when the government promised you pension from 65, but the life expectancy was 57. So it was actually in reverse, and it was like an empty promise. And I think that what you're seeing in France today, where they're raising the pension age from 62 to 64, and you see how much blowback that is doing, I think that will happen around the world. So plan A, if you're in retirement, look at how you can still create active income. Maybe it's one spouse, one half, the husband or the wife, just working. Maybe it's part-time work. Maybe it's consultancy. Maybe it's home-based. Maybe it's freelancing. Stay productive, because I think that number one thing for a retiree is to stay productive. So that's if you're 65 and older. If you are in the workforce in America today, deglobalization is the best thing for you. If globalization is what killed the American middle class, where you offshore everything and anything, and whoever runs companies, the headquarters, and the higher ups, that's how you got this incredible wage gaps, income gaps, and wealth gaps in America, because basically the owners of assets became very rich between the 1980s and today, whereas the average worker saw his value getting pushed to countries where they have an arbitrage on wages. Today, it's the opposite. Companies are going to struggle, so shareholders are going to struggle, the owners are going to struggle, and what's going to flourish is whoever can deliver value at the bottom line, at the lower levels. And so I think that if you're in working age America today, you should, one, see if your career path is a good one. If you can advance in the occupation and profession that you're in, and if not, then you have more opportunity today to search for great career paths than at any point in the last 40 years. You don't need an Ivy League or a connection to high tech or to Wall Street in order to be successful. There are many avenues for the average person, as you say, in America today, because there's a labor shortage, and so many companies are going to bring back manufacturing either to America or to Mexico or to Canada. By default, you will be able to be part of that new supply chain industry. Third thing is be a part-time in real estate. Anyone should be involved in real estate. Or I should say everyone should be involved in real estate. In some manner, be involved in real estate. If you want to become an agent, that's very, very quick, and you can do that. That's going to be more time consuming. If you want to do sweat equity and help investors find homes, do that and split deals with them. If you have no money for yourselves, if you can become an investor, do that. But be involved in real estate, because, as I said, 70% of U.S. millionaires over time have come from real estate. Anyone can do it. It truly is the quintessential last bastion of capitalism in America, the real estate or the housing industry. And you can get involved in that at any age, which is something that I really like about it as well. And because demographics are changing so much, there are opportunities throughout America in real estate. So that's number 3. And I think that that should be your primary engine, your active income. If you're asking me what should the average person do, should he buy 2 ounces of something like you said? No, the primary thing is how to increase your active income. I think that number 2 is what to do with that discretionary income once it comes in. And so that's where I think that if you understand that we are entering a dollar bear market, and what that means to your savings, because higher interest rates are going to be the biggest catalyst for the government to inflate the debt away nominally, then you need to protect your purchasing power. And in order to do that, you need to own the real inflation hedges that we have. And so that's number 3, owning inflation hedges. There are some companies that are able to be inflation hedges in and of themselves, and you should look into them. Companies with a lot of pricing power, companies that sell things that are not wants but needs, and those are able to deliver better results during this time.
Excellent. Wise words. Thank you for those ideas, and I hope everybody can pause the video and then go back and watch that again, because those are going to be the keys to A, preserving wealth, and B, the success to move through these times. It's challenging times. And, if you do have land and you're able to get into that, you're able to produce some of your own food or have others come out there and help you. And, having land, having real estate is going to be the core, and the key always has been to being able to set up your own bastion of safety, for a better term. I don't think why it wouldn't work now if it's worked for 5,000 or 6,000 years, just because we're in a time with computers. Some of these same things are valid, whatever time in history we're going back, thousands of years, hundreds of years, same, but different, as I've heard it stated. Lior Gantz, Wealth Research Group, thanks for joining. I'm going to put all the links so you can go right there, /portfolio, check it out. And I'll leave a link for the newsletter as well, so you can sign up for that. So Lior, I do appreciate your time in it. And if you have a last thought, I'd love to hear it. But thanks everybody for joining.
Yeah, sure. I wanted to just say a lot of people are concerned about central banks' digital currencies. So we've created 2 special reports for your viewers. If they want to check out wealthresearchgroup.com/CBDC and /CBDC2, the number 2, that's a 2-part series about central banks' digital currencies, and that's compiled from data that I researched from the IMF, the World Bank, and all the countries and central banks that are engaging either in pilots about CBDCs or have published academic papers about the subjects.
Again, understanding the world we're moving into is a very important thing. It's very hard to take action if you don't even know what's possibly coming next. It's literally like standing on a railroad track with your back turned toward the train. And, okay, maybe I'll guess when I can jump off without opening your eyes. A lot of things are out there for us, have been broadcast where it's going to move. Now it's just having, somebody else do the research and consolidate it for you to save you time and then make wiser choices. So Lior, thanks again for coming on.
Thank you for having me.